Hello and good evening. In my case, here from Berlin, Germany. Probably good morning, good afternoon, wherever you are. This is an international format, so could be that you're probably joining here from, let's say, Tahiti in the morning, sunset right now. I don't know. My name is Jens Klatt, and I will present to you the upcoming 45 minutes here how to trade the markets profitably together, in fact, with Admiral Markets. And in this case, we want to have a look at the Open Range Breakout. And I'll do something, well, I'd say something special right here, or I have a plan to do something really special, because I want to present to you a way to trade the Open Range Breakout today, which would have caused a loss, in fact, today, even though I think the idea behind this is still valid and something to take into account here, not only when trading the markets based on the open range, but probably also based on other trading approaches, and also when trading the markets from a discretionary perspective. But before we start with this, I want to show you here the risk disclaimer. Oh, I'm sorry, that was a little too fast. So the risk disclaimer, I want to emphasize here that trading with financial instruments offered by Admiral Markets, CFDs, ETFs, stocks, that they carry a high level of risk, and this is probably not suitable for all investors due to their complex nature. And before entering into any agreement or transaction, please make sure that you read the terms and conditions of the service from Admiral here. If necessary, consult a specialist and ensure that you understand the risks involved in trading. And also, please study carefully the so-called key information documents, or short, it's KID, in order to understand the nature, risks, costs, potential gains and losses of margin products offered by Admiral. If you want to get access to these KID, to these key information documents, feel free to contact Admiral directly via mail and ask for them, and they will promptly forward them to you. Several reasons, by the way, why Admiral Markets as a broker is definitely worth a look here, a deeper look, especially if you're an index trader. Here in Germany, Admiral is considered to be the DAX specialist, in fact, offering a typical spread of 0.8 points here during the main trading hours. This is during Xetra trading hours. Right now, in fact, there's a special offering here, and the special offering is that thanks to the birthday of the DAX 1 week ago, when the DAX turned 30, in fact, that Admiral decided to offer for the month of July 0.5 spread here, fixed with no commission on top or something. And so if you're a client, you are already enjoying the pleasure to trade the DAX currently with 0.5 point spread. If you're not, you should definitely have a look at the website from Admiral, and and at least minimum download a demo. And we have seen several reasons why the spread is very, very important in terms of the commission and all this, and that commission is something, or especially the spread and commissions, professional traders look at here when deciding with which broker they plan to trade. That this is definitely worth watching here. And on top of that, the regulatory background here, Admiral is authorized and regulated by the FCA. And on top of that, here the contact details, where you can contact Admiral. In terms of YouTube, I highly recommend to subscribe to the YouTube channel, so that you're all the time aware of when a new and special webinar here is uploaded. Then there's plenty of webinars. You can check all them and which topics you can expect here on the website from Admiral. This is me. And now we want to have a look here at 3-step intraday trading strategy for the S&P. Probably you've heard about this already before, not necessarily here. around the webinars I'm holding here for Admiral Markets. But this strategy, in fact, the Open Range Breakout, is a strategy which was brought to the public, not necessarily invented, in fact, but it was discovered and then brought to the public by a guy called Toby Crable. Toby Crable is a very successful hedge fund manager, currently managing several billion and having at least a track record of, for the last 20 years, as one of the most successful CTAs here, so-called commodity trading advisors. These are also money management firms who have a license as a CTA here. And Crable is definitely someone to listen to when he talks about the markets and his way to trade the markets. And the Open Range Breakout was one of the setups he brought to the public and to public attention here around, in fact, 35 years ago. And it's a very simple approach, even though a highly effective one, and it can be adopted to several markets. Not only can it be traded on the S&P 500, but I've also, and mainly due to the fact that here there's the special offering from Admiral currently with the DAX of 0.5 spreads, I've adapted it to the DAX. Respectively, I want to present you how I trade the Open Range Breakout in terms of the DAX, not only the S&P 500, even though on Wednesday, and you can already register for this webinar, on Wednesday at 4 p.m. German time, this is 3 p.m. London, we'll stress test the strategy here for the S&P 500. That's the reason why I want to have a look at it here. Even though, again, you can also adopt it to several markets. What they have to have is, they have to be very liquid. It has to be a deep market. It has to be a quite broad market with lots of market participants. So when focusing here on the S&P 500, this is definitely the case then, that you have a highly liquid and very deep market in this case. But also this is the case for the DAX. It's also the case for the bond future treasury markets. It's the case for FX markets. It's the case for blue chip stocks, for example. You can trade stocks via Admiral here. And in this case, then, for example, Google or, I don't know, Amazon, whatever. The only thing you need to do is you have to make some small adaptations here, even though if you've done them, then you will find out that this approach can be traded here on several markets. And therefore, let's have a look here, first of all, at the Open Range setup then for the S&P, how I trade it, even though, by the way, what I present to you here is one Open Range setup. You could also run it several times a day, for example. So I have a setup which can be adopted then that way, that you have 3 different ranges, and every range could be triggered here. So for example, saying you have 3 ranges and then risking, let's say, 1% per trade per day. That means per trade you risk 0.33%, and then first range somewhere in the night, then some one range within the, I think, first 40 minutes of trading, and then the next is about the first 50 or 60 minutes of trading. But we want to focus here, and we don't want to overcomplicate things here. We want to only focus on one open range, and this open range is defined then between 3:30 till 4:15 p.m. European time, Central European time, in this case, German time. And then what you also need to do is you have to identify an advantage. Very, very important. Sometimes people do not define this advantage and get lost in details like how to optimize the entry of a trade, how to optimize the exit of a trade. The thing is that if you do not have an advantage, in the long run, you won't make any money trading the markets. And in this case, you can compare this to a casino, for example, offering roulette here. The casino does not care whether you're winning one game. And in fact, the casino does not even care if you win 10 games or 100 games. And if you go out of the casino after one night of playing roulette here and walk away with, like, let's say 1,000 euros, because the casino knows there's a natural tendency of human beings, first of all, to return, and not only to return, but that they have an advantage, and over the long run, the expected value is in their favor, meaning thanks to the zero they have on the roulette wheel here, they have an edge, and even though it's only a small edge, it's an edge which will play out over time. And this is the same thing you have to identify in your trading, and this is what we do here in the second step. We identify our advantage based on the 15-minute exponential moving average 10 in this case. And the very simple approach is, if we trade above, we go long. If we trade below, we go short. Meaning, in fact, when we break out of this open range. So in the case of the DAX, for example, it could be that, or also the S&P, you trade above the exponential moving average 10 here on 15-minute time frame, but then break out of this range on the downside. You don't have a trade then. The same is true if you're trading below that and you break out below the exponential moving average 10 here, and you break out on the upside. You don't have a trade. So you have to wait until the market, in this case the S&P, trades back above the 15-minute exponential moving average 10 here in this case. So in the third step, simple one, we trade the breakout of this range, obviously, in direction of the identified advantage, stop above, respectively, below the high-low of the range. The take profit is set that way that we say, okay, we take out the trade at 9:50 p.m. Central European time in our case, so 10 minutes before Wall Street closes then, and not before that, not after that, but right at 9:50. So we do not have any take profit levels based on market structure or pivot points or Fibonacci extensions or whatever. We have a time stop. If you want to take out the trade at 9:50, that's it. So that said, probably makes sense to not only have a text here, but have a look at how this looks in practical terms here. And this is the 50-minute S&P, and I've already, as you can see it here, I've already prepared it for today. And this is exactly what I mean with a fake out in this case. So you can see here this small spike on the downside. And this is something where from time to time you definitely will get furious when looking at the chart and just thinking, really? You get spiked into the trade and then the market candle, which is relevant for you. The first three candles, this is 330, 345, and this is 4 in this case. So when this candle closes, it's 415, and you place the stop, in this case, the sell stop, depending on whether you trade above or below this blue line. As you can see here, you're slightly closing below this blue line. That means you will place a sell stop order, and this one is triggered when the market here hit these lows, and obviously it turns around. So now you might say, okay, this rule is probably not working, or this setup in general is not working. And this is, by the way, one of the reasons some probably will listen to this right now or listen to the recording and wondering, why should someone who says of himself he is a professional trader, why should he give away his, let's call it, trading secret? Why should he give away his or one of his most profitable trading strategies? What's the reason behind this? And even though it might sound arrogant, but the thing is that over time you will find out that you have tremendous difficulties to only duplicate the trading strategies from someone else. That's one of the reasons why usually or professional traders do not have any trouble to give away their, let's put this in quotation marks, secrets here, because they know it all comes down to mental stability, and it all comes down to really follow a clearly preset defined rules here. And this is where trouble kicks in for most of the people. So after seeing such an example here, I bet that minimum 20% of all the people listening to this right now will just say, okay, the strategy does not work, because this is really frustrating. And you can't believe it, by the way. I have running a similar strategy right now, not on the S&P, but in the FX market. A similar strategy means I had to make some adaptations, even though I did trade them in the FX markets right now. It's not working. Well, it's not working means I trade through it and I'm not making one dime here. But in fact, I'm behind on this account in this case for something like 2.5% or that for the month. And this is I can tell you this is really frustrating. You're sitting in front of the screen, you know you're trading with a positive expected value. The strategy works. What do I mean by positive expected value? What I mean with it works? It means that you run a backtest here over a significant time span, in this case 5, sometimes 10 years, and you will find out that over a long period of trades, or many trades in this case, so we're talking about 1,000 trades plus, you generated a positive expected value thanks to the fact that the hit rate multiplied with the average gain of the strategy, and you subtract the loss rate with the average loss of the strategy, came out with a profit, so it's bigger zero. This is how profitability in trading is defined. In fact, it's a positive expected value, but it's over a long time span, and there's surely a period within which you won't see a positive result of this strategy. So this said, what does it mean? Well, it could be that there's a series of 10, 15 trades in a row you're losing. That's not uncommon if you're only trading the strategy, by the way. So if you're then combining this with several strategies, not only trading one strategy in your portfolio but several, well, obviously you won't have a run here in this case of 10, 15 trades in a row where you lose, because other strategies will definitely generate a positive trade rather sooner than later, and over the long span it will just equalize each other. Nevertheless, just imagine you're only trading the strategy and sitting in front of a screen, you only have one trading signal per day, and you're losing, in this case, 10 trading, 15 trading days in a row. That means nearly half a month, respectively, 75% of a month you're losing. And this said, now let's close this cycle here. This said perfectly illustrates why usually it is very difficult to only duplicate the strategy from someone else. So if you follow someone on Twitter, if you follow him on Facebook, if you follow him on, I don't know, Instagram, he's posting pictures of himself with the Lamborghini and really presenting himself as the trader and saying, you know what, register here, download the strategy. I can definitely assure you that you won't make it with this strategy. So probably you get lucky and the first 3-4 trades work out. But over the long run, you will have more than often such a signal here. I mean, let's assume in this case, by the way, that the strategy is profitable. There are several guys out there giving you their trading secrets, which are not profitable at all. But let's assume that it is really profitable, and you will see that this strategy, in fact, is profitable. But this is the next step. So nevertheless, if you see something like this happening, you will go crazy. You will just go crazy about this. And if you do not have the necessary trust in the strategy, you will definitely not be capable of trading the strategy longer than, let's say, 1 week. By the way, this very great example in this context. So I held several live trading events in the past, in fact, and there was also a series I ran, and I was trading this open range strategy here. I think it was also on the S&P, by the way. I'm not sure, but what I know is that I traded it 4 times, 5 times in a row, and all of that was right at the beginning of the series, and I lost on every trade. And the interesting thing was that after 6 months, so I kept on trading the strategy over and over again, and every time again. And after this period of 6, 7, 8 months or something, I just did a recap, and I said, look at this now. This is the result, and we were ahead. We're significantly ahead. We had something like 15% profit or so in only 6 to 8 months, something like that. And I said, well, just imagine the following. We started out here with 4 losing trades in a row. And I bet that many of these guys who listened to this here at the beginning are probably not aware that we just see a profit here right now. And this has mainly to do with the fact that we are too attached to the outcome of only one trade and not to the to all trades in combination, and really think that this trade gives an idea on how profitable the strategy is, in fact, or is not. And by the way, so first of all, what I already said is I would do it the exact same way again, and this is no surprise because, well, the signal is clear. We traded below that. We have a clear preset defined rules here. set of rules here, which says we are trading below the 15 exponential moving average. It doesn't say how much we have to trade below. We have to trade below this. EMA 10 in this case here, we go short if we trade below that. And so I know that the result is profitable. I know, because let me just skip this here for the DAX and switch over here. Oh, by the way, I'm sorry. Switch over here to this backtest result. So obviously it is profitable, and you can see that this trade, this example, is only one out of, in this case here, of a time span of something like 7 years, over 1,300, and we had a hit rate of 47%. That means more than in half the cases we were on the wrong side. That means something like 700 trades just lost. It's just part of the game, part of the strategy. Nevertheless, it's still profitable thanks to the fact that the average profit is 1.3121 in this case, resulting in overall positive expected value, meaning that on average we make 8 cents per every euro we risk. And this is resulting in this rising equity curve here in this case. Nevertheless, this is part of the game, to just accept, swallow this pill that we just got triggered and got stopped out within minutes after that. There's another thing I'd like to present to you here. Not only that we clearly followed the rules here, but by the way, 1 second, I just have to have a look here at something. 1 second again. So there's another reason to that, which you can then probably adopt to other trading strategies, discretionary trading approaches here in this case. Let's just have a look here at this picture. So I just switched from the 50-minute chart. I switched over to the hourly chart, and it's something really interesting which is happening right here. So I just zoomed into the chart. And what you can see here is obviously the market was trading within a range, and then we saw a significant breakout here on the 6th of July here, in fact. So that was last Friday. Significant break, and the market just kept on pushing higher. Okay, fair enough. Now, the thing is that it's not only that we are seeing a quite significant region of resistance here on the upside, but there's something different happening here. If you look at it from a so-called price action perspective, what you can spot here is a sequence of rising highs and rising lows, and the market, it can definitely be considered very extended on the upside here. So how do we call this? We call this market trading within the so-called distribution area. What do I mean by that? It's another way to say that the market here, from a risk-reward perspective, is quite unattractive for long engagements. So the thing is that, in fact, you're more likely to expect the market to turn here than you expect it to continue to push higher, which is even more interesting now to see after, for example, the resignation of Boris Johnson several minutes to 2 hours ago, something like that. So he resigned because Theresa May. You probably have heard this, and this is, for example, also one good reason to explain the current high volatility in pound sterling on a broad scale here. He said he will step down as the what I think it was the German word for this is Außenminister. I'm not sure what's the English word for this, by the way. One second. One second, please. Let me just have a look it up here. Foreign Minister, yeah, makes sense, sure. So our Secretary of State. Okay, so he was the Secretary of State here, and now he resigned because over the weekend, you have heard this too. There was where there are now signs which are showing that chances are rising that there will be some kind of, let's call it soft Brexit here. And this is interesting because usually would expect the market after the resignation of Boris Johnson now to probably take a hit. Why? Well, because it is not likely, in fact, that Theresa May will stay the Prime Minister of the UK. And in fact, if you look at pound sterling currently, you will see exactly that. So pound sterling should rise on this news, but in fact it sells off because this is giving the whole the whole story right now around the Brexit in UK. It's giving it a very difficult touch because chances are rising that probably Theresa May will step down too, which will then result in kind of uncertainty around the future from a political perspective, and also who will follow on Theresa May. Probably will be, let's call it a hardliner, who is then pushing for a hard Brexit here. And so all in all, if you ask me, I'm not really convinced whether with this push higher from this perspective, based on this argumentation, really makes sense or not. But however you put it, the fact is that the market is pushing significantly higher. Nevertheless, I consider chances more or higher that the market will rather sooner or later see a corrective move here instead of only pushing in one direction here and presenting itself in a one-way street, let's say. And why do I say that? Therefore, I've prepared something for you before this webinar to explain to you this concept of accumulation and distribution area a little better. I hope that you can see this here. So what you can see is this is it's for illustration purposes only. And you have a sequence here of higher highs and higher lows. And so what I show here is once the market makes it to new highs, so a sequence of higher highs and higher lows is an uptrend, okay? So in the market here goes over from this green area into the red area, very easy or very set in a very rough way. And what I say here is that building a position when the market makes new highs into the distribution area is not optimal. Why do I say that? The reason for that is because let me just try to do this. That's perfect. The reason for that is the following. By the way, this is something I haven't prepared, but I only have to make a snapshot here. Second, please. So the thing is, and this is what I'm referring to when talking about the I'm talking here to about the risk reward. What you can see here is that if you trade it that way, and now assume that the market really will push in our direction here, you will say, okay, the risk reward when placing the stop here and going along with the breakout to new highs. Well, obviously, in this case, the risk reward is still okay. The thing is that it's not said that the market will move that way. Plus, on top of that, and this is what illustrates my argumentation even better, is the following. So what usually professional traders try to do is they position themselves into this so-called accumulation area here. They try to do this based on the fact that they minimize their risk because they know that they have to place their stop here. And on top of that, if the market really moves that far in this direction, obviously the risk reward is getting very, very, very attractive in this case, in this context here. And so with this said here, you can perfectly understand what I'm talking about when I say the risk reward is getting really unattractive. Because the thing is that here, after this breakout and after the market broke already significantly higher, you see the market pushing to a region where you are really careful, or you should be really careful in terms of long engagements because the risk reward is not that attractive. Plus, on top of that, chances are not that bad, I think, that the market will at least show a retest of this former highs here around 2,700 and I think it's 42, and show at least some intraday bearishness, probably taking off from there. Then that's that's something completely different here. But initially, I'm definitely I feel okay when saying why not going or aggressively trading the short side from here, with looking at this picture, at this current price action, and the fact that the market is quite extended on the upside already, and is likely to see a retest of this region here. And so with this in mind here, in fact, I then say again, I think it's completely okay to say, well, that was just, let's call it bad luck here in this case. So it was just bad luck. We got triggered here, but chances were quite good from this price action perspective that there will be at least a push. And by the way, in this case, so what are we talking about here? We're talking about, in this case, something like 30 points, 25 probably, 25 points on the downside in the S&P, with a risk here of something like 6.5, which is giving us a risk reward of 1 to 3 and slightly better than that. So it's in fact very, very attractive. And yeah, unfortunately, again, the market pushed higher from here. Now, some of you might probably say, hey, if you're looking for an advantage, I mean, and seeing that the market broke out sharply and pushed sharply higher, I mean, it clearly shows and clearly illustrates that the advantage can be found on the upside. So why should we go short here in this spot? Again, it's first of all, it's the rules of this trading approach. We're trading below this exponential moving average 10 here in this case. And on top of that, if you add to this the fact that the market is quite extended on the upside, in combination, I think it's definitely worth to give it a try. From a risk-reward perspective, I think considering short engagements here is far more attractive than going for the long side, even though now we will definitely say, okay, but obviously the market pushed higher. But this, from trading psychology, comes into play again. Cognitive bias here, where in this case a hindsight bias is something to really remember. That's the same, which is true, for example, when looking at the election of in the US here, of the US president in 2016. There were plenty of people around this time now, 2 years ago, who said, well, it would be kind of funny to see Trump being the 45th president of the United States. But I don't think that this will happen because, yeah, let's put it that way. People are not that stupid to elect such a guy, but instead they will probably go with someone like Hillary Clinton, even though, yeah, Hillary is probably also someone to be a little suspicious about. I'm not sure whether this should, but she's definitely someone where you can say, okay, we know what to expect about this, and based on that, people likely tend to give her vote. Now the thing is, it turned out completely different. And now, interesting enough, after Trump got elected, people were like, yeah, well, sure, it was clear that Trump will be the next president of the United States. But they said this not because they were really sure that Trump will be elected, but it was more likely they said it because Trump was elected. And based on that, you can easily duplicate this point here to the current situation in the markets and how the market presents itself, and especially now, and in this case here, scroll down to the 50-minute chart and intraday trading perspective, and now you see that the market broke out, respectively stopped out the short trade, and you will definitely say, yeah, sure, it was clear that the market will do that. But you should be aware of the fact, when you entered the trade here, you didn't know that this will happen here. So currently you're looking at a chart from right to left, but you trade from the left to the right. And this is something you have to keep in mind here in this case. And again, I think there were good reasons, not only the reason that the setup itself was short here in this case, but also that from a risk-reward perspective, it was definitely worth to give it a try. So that's it in case of the S&P. I promise to you to also illustrate and show you, let's probably do it that way, show you the 3-step intraday trading strategy for the DAX here in this case. And by the way, what I just presented from a price action perspective, the interesting thing about this is, you can copy this to several approaches. For example, I can give you an example from my personal trading. So currently, I'm not trading the strategy because it's not showing a positive expected value. This has mainly to do with low volatility, in this case in Euro USD. But there was a sentiment-based strategy I presented in my first book, only available in German, by the way. And that was such an easy trading strategy that most of the readers and people I talked to after publishing the book couldn't believe that the strategy is profitable. But in fact, it is. It's the 50 simple moving average and the 20 simple moving average, and the simple moving average crossover system. And then you go long, respectively, you go short based on a retail sentiment. For example, if the retail sentiment of a broker shows a net short positioning, that means that more people are short in Euro USD currently than which are long. You only trade long setups, in this case crossovers from the 20 above the 50 simple moving average here. You only go long, and you trade the short side once the market triggers the 20 simple moving average crosses the 50 simple moving average from above, and the retail sentiment presents itself net long in this case. And so this said, now you can probably see how to use this. So let's come back here to the hourly chart again. Interesting enough, you can say, okay, let's assume that you have such a strategy running, and now you see the market being quite extended on the upside. What does it mean? It means nothing more than that you probably should reduce the position size when entering long engagements in this current region. So probably you will take the engagement, you will go long here, yes, but nevertheless, you won't take it, let's say, with 1% risk, but you trade it with only 0.5% risk or something like that, aiming for optimizing the overall positive expected value of the strategy. That's also a way how to use this, what I just presented here, from a price action perspective, higher highs and higher lows, and the accumulation respectively, the distribution area here. Okay, so now again, let's come back to the DAX. We do exactly those 3 steps as we did with the S&P. In case of the DAX, then defining the open range here between 8 to 9:05 a.m. German time in this case. Why do I take 8 in this case and 9:05? Seems weird at first glance, and very simple. So first of all, I already referred to the main trading hours, within which at Admiral Markets, for example, currently you can trade the DAX with a 0.5 point spread. This refers to the trading hours from 9 a.m. to 5:30 p.m. German time. This is the so-called Xetra trading hours, and this is when the spot market is open. Nevertheless, the DAX is open. The reference market is open from 8 to 10 German time in this case, so 8 a.m. till 10 p.m. and this is the so-called FDAX, the future DAX, and you can trade it at the Eurex here. This is the reference market, and usually what you can see is that the market starts to build such a trading range, such an open range here within the first hour of trading between 8 to 9 a.m. German time, and then with the breakout of this range, you can you don't not only have an open range then defined, but you can also formulate a trading setup based on that. Nevertheless, the thing is that I adopted this to 9:05 because what I found out over time was when the main trading hour starts with Xetra opening at 9 a.m. German time, there is lots of volume pouring into the market. You can see this. You don't have to pay for this, by the way, but you can check several portals covering the financial markets, and there's usually in Germany especially you can see those small charts where you can see the intraday price action, even though it's delayed, but nevertheless you can also see the volume below this. And the interesting thing about this is that at 9 a.m. there's a huge volume spike. The same is true, by the way, at 5:30 then. So the volume really pours into the market here, and based on that, the market, in this case the DAX, tends to show itself really erratic, and to not being caught on the wrong side in this case, because usually the market probably sees a short spike out of or above, respectively below the highs between 8 and 9. Nevertheless, it's not a sustainable move. And that said, I try to filter this out by only by saying, okay, then I take 9:05 instead 9 a.m. And I filter out this noise happening around the spot market open here, and that's why it's 8 to 9:05 a.m. German time then. Also here we identify the advantage, but here not on a 15-minute chart, but on a 5-minute chart. It's a 50 exponential moving average. Some of you might wonder why 5-minute, why 15 on the S&P. There's no special reason to that, only that it's a personal reason, because my mentor, when I started trading something like 10 to 12 years ago, was trading on a 5-minute time frame. In this case, the DAX, by the way, and I never changed this. And that's the reason why I stick to this 5-minute chart. Same is true here as for the S&P. If we trade the DAX, in this case, trades above this 50 exponential moving average, we go long. If it trades below, we trade the short side. And then what we do is we trade the break of the open range in direction of the identified advantage. Stop above, respectively below the high and low of the range. And by the way, I've not put my take profit here in it. The same is true for the DAX in this case. Trade is taken out at 950 if the stop is not hit, or we trade with the risk reward of 1 to 2 in this case. So meaning we identify this risk here based on our open range. So let me show this in this chart. It's probably a little better. Go to the 5-minute DAX here. In this case, 50 exponential moving average. And so these two lines here, they define the open range. This is 29 points. This is 1R. So the difference between the high and the low of the open range is 1R. We're trading below that, so obviously we are short this day here. And so it's 29 points. If we work with a risk reward of 1 to 2 here, that means that we are working with a target then 58 points from the away from the open. Also very unlucky, in fact, because the low of this range can be found here at 537. Yes, and if this is 29 points, that means that we are working with a take profit 58 points away, which can be found then at 12,480. You can see the low was 490. So 10 points, we got short, or we didn't hit the target by 10 points, and that's a little unlucky, let's say. Now seeing the market turn around again, the trade obviously did not hit the stop yet, which means most likely in around 3 hours from now, if we're not making new intraday highs, the trade will be taken out then manually. It doesn't seem as if the market will hit those lows again. And also here, some of you now might wonder, is this really profitable? And I've also prepared a backtest here, even though not one above over 7 years, but only for slightly more than 1 year. The value of such a open range breakout approach comes out somewhere between 5 to 10 cents. It's the most realistic outcome is somewhere around 6 to 7, 8 cents probably. And the interesting thing is that the expected value for the S&P was 8 cents, and the expected value here for this strategy, even though we only had a hit rate, which you can see here, of 42%, which is significantly below what you should usually expect. So usually the hit rate of such an open range approach can be found around 45 to 50%. So with our hit rate, we are below what we should expect. And then on the other hand, nevertheless, we had a quite impressive payoff during this time span with 1.57 to 1, which is giving us a profit of 8 cents per every euro we risk. And so this is really interesting because the expected value comes out in exactly the same range as you should expect it to come out for such an open range setup. Yeah, and in this case, also here, a chart with a 10,000 euro account. By the way, I've run this back. This 10,000 euro account. It's 1% risk per trade. This is also something you can see here with the average loss, which is 99.70. So it's very impressive, and very, very impressive, in fact. Nevertheless, having a hit rate of something around 50 slightly below 50% is definitely something to to make sure that you understand this. From a mental perspective, it's really difficult to trade this, and you have to really believe in your trading here, and you have to have the capability of think in expected values, of think in probabilities, and this is something which many, in fact, don't believe, respectively underestimate. And this is something which is probably one of the reasons then why many traders fail, in fact. This, by the way, true. We could now go into much deeper details here and have a look then at aspects like loss aversion, and I could illustrate this with real charts, real trading results over 9 million trades, in this case only for the Euro USD, showing you that the hit rate was something like 60%, while the payoff was significantly below 1, in fact 0.5 to 1. So you had on average twice as your loss was on average twice as high as your positive as your gain, and based on that you had expectancy which was negative, and all in all unprofitable. And yeah, with this said, this is something to really understand and to believe, to make yourself believe that you don't need to be right more than 50% of the cases to make money trading the markets. But nevertheless, and this is the thing again, and this is where the cycle closed now, the thing is that you can give away this trading approach with no big problems. Many people just will fail to trade it because there's a deep lack of trust in the strategy. And nevertheless, if you build this trust over time and understand that thinking in probabilities make you a successful trader, you can easily duplicate such a strategy. Nevertheless, it's a long way to go from here, and that's it from my end. So I hope you enjoyed this webinar. Please share your feedback on Twitter, respectively on YouTube. Subscribe to the YouTube channel from Admiral Markets. Send an email to the support if you liked it. If you have other assets you want to be covered here in some way or not. I'd really appreciate to get your feedback. All the best from my end. Have a nice evening. Happy trading. Watch your stops. Talk to you soon. See you. Take care, and bye-bye.